All right. So I presume all are now getting set to hear the real cream for this seminar street. And I'll also be introducing individual speakers as the panel discussions also start happening. Typically, the viewers, I hope they are in the right mode now, because now is the, shall I say, IFRS and Ind AS treat we propose to offer to you starts in that sense. So be ready, be alert, have your headphones or your sound volumes well in line, capture every word, whatever you look forward to, and also ensure that you are having something very clear. If you don't have something clear, on the spot, send a message to me on my WhatsApp or to Bridge on the email. And they are being continuously monitored. So send the queries on the spot to Bridge and me on WhatsApp in case you don't get any point clear. Right. So we go ahead with Ind AS implementation, how to do it practically. We all know the implementation roadmap. So I'm going to the implementation roadmap slide. The benefits are known. Actually, countries like Japan, Mexico have gone to zero rate of interest. So we all of us are dreaming that a bullet train from Japan, which comes with a 0% financing, it becomes a great boon arising out of the free capital flow. Then our credibility to foreign investors is growing up. Then cross-border investments are happening. Efficient capital allocation is happening. All these are advantages, and they will be discussed at length. Right. We all know that India signed the G20 to go for IFRS in 1411. And the point was, should we go for adoption or convergence? And this is all history. But the 2010, the issue came up, adoption or convergence. And convergence was agreed. And then that time, post-postponement, Arun Jaitley finally announced the roadmap. Phase 1, which is voluntary, 1/4/15. Then phase 1, 1/4/16 is mandatory. Now, we know that that is for companies having net worth more than 500 crores. After that, the phase 2 is mandatory for 1st April 2017, unlisted companies above 250 crore net worth, and all listed companies. Banks and insurance 18-19, and IRDA insurance also 18-19. Crompton Greaves, in fact, I'm proud to say that my first job was in Crompton Greaves, and they decided to voluntarily adopt Ind AS for 1/4/15 itself. Whereas 1/4/16, the 500 crore and above people will have to do, and 1/4/17, 250 crores. The net worth to be considered as on 31st March 2014. And the whole group has to be covered: holding, subsidiary, associate, joint ventures. And MCA declared the Schedule 3 format in line with Ind AS for financial statement in February 16. Here is a roadmap further. RBI on 11th February with the circular given, date is given 315, where one has to comply with Ind AS for 1/4/18, both standalone and financial consolidated statements. The press release was made on 18 January, and the further directions were given that pro forma statements will be required, and IRDA has also recommended that we start from 1890. Here we go for IFRS and Ind AS tips and tricks. Well, go to any consultant and he says standard phases, impact assessment, transition date balance sheet, and a long questionnaire is given. There are systems and IT issues, top management support. These all motherhood statements, all of the implementation people have made. What is the reality? In fact, in many places, AS and Ind AS is same, and that itself is not complied, or complied, but many cases are twisted. A Ganga Snan we call it. Other day I was in BCA's meeting at Lonavala, and a Ganga Snan has become a popular word, where even whether we were complying the old Indian accounting standard itself is a question mark. So that AS compilation correction itself takes a clean wash. So leave aside complying with Ind AS. The Ind AS, wherever it is similar with AS, now is coming up with a heavy hand in terms of whether we are complying with that itself. What are the areas one comes across? You come across many organizations which are preparing the accounts, and some of you might have heard that there are accounts which are shown saying the consolidation has been done. However, certain subsidiaries are not compiled, or consolidation has been done without sufficient financial statements availability, and really they have been covered by way of management certified financial accounts. All this one will have to forget in terms of. So let's talk about what are the experiences one gets. And here I'm sharing the practical experiences of many of my friends in Big Fours, many of my Ind AS implementation champions, many of my own personal experiences on IFRS and Ind AS implementations. We have been facing this presentation issue right from revised Schedule 6. Revised Schedule 6 and now Schedule 2 and Schedule 3 rather of the Companies Act, which is giving the format of financial statements. Itself, there are big challenges whether people who are having large NPAs, are they showing the bank borrowings in terms of proper classification, in terms of what do you call it as a current and non-current. I would like to, in fact, have either CA Institute or CMA Institute to analyze top 100 defaulters of India and see their financial statements, are they properly disclosed. Many of the cases, in fact, the going concern assumption can be challenged. But the question is it being challenged by the management itself or the auditor, or who is looking into that aspect if their accounts are NPAs? If the accounts are NPAs, shouldn't the Ind AS financial statement, or rather even AS financial statement, should be shown as question mark on going concern assumption itself? These are some of the issues. Then you come across huge impairments not carried out for the fixed assets, tangible assets, PPE. You come across many intangible assets not recorded at all. And apart from that, are the presentations of assets and liability are done more to comply with the standards or more to please the shareholders, is a question mark. I had the privilege of working at least 15 out of last 30 years of my industry career as a CFO and finance director. And I always used to wonder, and today I classify the companies into two types of companies. One, who want to show higher profits, play on the share market, and then take the share price up by jacking up the profits. And there are second type of companies who who wants to show the profit less in order to do the tax planning and saving of the tax. Now, Ind AS is going to come with a heavy hand on this because they are prudent over conservatism. What are the various tools which Ind AS implementation, where I'm talking about tips and tricks, are going to provide for? A simplest thing is controlled entities. Are we already covering the controlled entities or not? Is a question mark. The answer is no. Otherwise, why C&AG, Comptroller and Auditor General of India, is finding lots of so-called entities whose accounts contained Benami transactions? And why are some of the loans rescheduled are not shown as impaired in some of the big NPAs which are currently discussed and published in the... How come somebody who is arrested, a lot of black money comes in his name, and don't you think that those group entities should be consolidated? How today all those list of crores are available? Shouldn't the financial statement itself should show that or not? So we are talking about Ind AS and IFRS financial statement, which should consolidate all these entities with a proper implementation of the fundamental called controlled entity. Now, the word entity therefore says that any associate or subsidiary or joint venture who has got an influence, either dominant or joint control or significant, they need to be consolidated. And the entity means need not be necessarily a corporate, it can be partnership, LLP, trust, cooperative society, etc., etc. I mean, many of the trusts are already being questioned on the overseas donations in order to increase the tax net wide, to make the tax net wide. So the question comes up, should this all not get captured by Ind AS financial statements? I mean, my humble suggestion to government, which I have sent to Prime Minister Narendra Modi ji also, that not stop at just the net worth criteria, but everybody who has got more than 50 crore bank loans, they should be made compulsory to adopt Ind AS financial statements. And this one move can capture lots of transparency, and auditors also will have a forceful tool. Now, how do auditors get a forceful tool? Today, auditors are able to disclaim a lot of information availability. However, on the other hand, the auditors now will be forced to avoid any disclaimers because it has to be an explicit, unreserved, unqualified statement that the financial statements prepared under Ind AS show fair view. And there can't be any subject to notes below, there can't be any except, etc., etc., etc. So, going forward from that, one wonders what kind of Ind AS implementation challenges one faces. It's an open secret, which, I mean, all of the professions are hearing. It's an open secret that there are people who are sort of, what should I say? They are sort of preparing the accounts and then not considering a lot of controlled entities. Now that will have to be done. There are various issues which can come out of that. Can the companies set up in the names of servants, drivers, maid servants? Are they needed to be consolidated under the group concept? The answer under Ind AS is yes. And that's where the catch lies for controlled entity. Now this is going to make, so we are talking about controlled entities and we are talking about many trusts and cooperative societies. Should they get linked in? Anyway, the RBI has come out with that even the scheduled commercial banks are also covered. Cooperative societies are also covered. The question lies that are we in a position to deal with these situations? And are the current Indian accounting standard based accounts when they talk about CARO, physical verification of fixed assets have been carried out. I mean, call all listed and unlisted companies CFOs or the owners and tell them to put their hand on their heart and say that yes, they have physically verified the fixed assets. A big question mark lies there. Now what happens? So now we say Ind AS must be complied 100% with fair value of the assets. This will completely stop this CARO certification, which is done as a without going into the depth, and on a broad presumption perhaps that there are no material variations. It is essential not only for compliance point of view, but shouldn't the owners have the control over its fixed assets, tangible assets, PPE? Should we not have that? And therefore, it is also in the management's interest to do something about it. And therefore, the Ind AS comes actually as a boon. And Ind AS financial statements, I presume, should treat this as an opportunity to come out with the professional approach. Same is the case with inventory verification. Is it really happening? So those are the areas. Are we disclosing the fair value to the shareholders? Come to some of the companies where you look into the financial instruments, which frankly speaking, accountants many times, and I have no hesitation to say, I'm also an accountant, they have become engineers. We should not be engineers of financial accounting. We should not be creative accountants. We should be really, accountants who are talking about clean accountants. Okay. And I'm sure my many CA and CMA young friends are listening this, and I'm sure the previous generations of ours has left the job to the current breed of professionals to make this country clean, because everybody has suffered from corruption. Is transparency and corporate governance based Ind AS financial statements are a solution for black money curbing? Obviously yes, because what is hidden, if that is required to be produced, then obviously, I mean, it's not a pinaka for all, but the point is that are we coming out with a professionalism? So I would say it becomes perhaps a professional India. Going forward from that, the financial instruments, how they are engineered or re-engineered. I mean, some accounts are publishing what is called as unsecured perpetual securities. Now, a layman like me, I mean, I call myself a layman when I see these accounting innovations. How can there be security which is unsecured? If you ask a common man, he will be lost. And then the question comes, how these unsecured securities are to be treated? Are they debt or equity? Or let us come about, suddenly you find, look at 7th October program of 2012 on CNBC, The Firm, which talks about redeemable equity shares. Now, when you see redeemable equity shares, it looks like a joke. And I'm sure now the government authorities are investigating. Long back, this kind of scam was also published, because the financial instrument treatment of the borrowings from foreign countries were shown as equity, and a lot of articles were written. And Maneka Doshi of CNBC TV had taken a big interview, because those equity shown were actually treated as, should have been treated as external commercial borrowings as per the principles. And this is where the young generation now, who is going to see Ind AS 32, Ind AS 107, Ind AS 109, which are very fearsome standards, replacing the standards of AS 30, 31 and 32. Now, how does one ensure that these standards are ensuring that the financial instrument treatment is given into such a light that the financial instruments are presented rightly? I remember DIPP came up with a circular that these ECBs should be treated retrospectively. I'm talking about redeemable equity shares, which should have been treated as ECBs, and whether they were complying the norms retrospectively. And that retrospective thing was objected by everybody. And further to that, what happened? There is no news. 7th October 2012, Mindwell, see the business standard, an article on